The McAlvany Weekly Commentary, covering monetary, economic, and geopolitical news events. Now, here are Kevin Orrick and David McAlvany.
Welcome to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. And David, today we're honored to have Dr. Mark Skousen, who's a professional economist, a financial advisor, a university professor, and he's an author of over 20 books. He teaches economics at Columbia University and is the editor of Forecasts and Strategies, which is an award-winning investment advisory service. He resides in New York sometimes and probably in Florida when it's cold in New York. Dr. Skousen, welcome. Thank you for joining us.
It's a pleasure to be with you. I'm in New York right now, but planning to go to Florida soon.
Well, super. I'll tell you, just as a pickup from what we've been talking about over the last few weeks, we really want to hear some of your comments. I'll direct this first question to David because it's a pickup from what we talked about last week. Last week, David, OPEC said that it looks like in the next 2 years we're going to see $200 a barrel oil. What's crazy now is Goldman Sachs, the monarch of the New York Wall Street firms, what Goldman says, Goldman does, basically. Goldman Sachs is saying the same thing. They're saying, go ahead and look forward to $150 to $200 a barrel oil. All this in the face of the collapsing housing market that doesn't seem to be stopping.
Kevin, a couple of other things that are noteworthy. Their first announced their first quarter loss of $11 billion. And no surprise there as they've had massive exposure to the subprime markets. Fannie Mae and Freddie Mac. Fannie Mae reported this morning. Freddie Mac reports next week. Fannie Mae registered a $2.2 billion loss. Expect severe weakness in housing over the next 12 months. I just want to point out one thing, Kevin, because we've talked a lot about Fannie Mae and Freddie Mac in the past, and before we get into a conversation on a paradigm shift and where capitalism goes from here with Dr. Skousen, Fannie Mae has changed some of their requirements, which I think is very noteworthy. What they considered delinquent loans was anything that didn't pay after 120 days, or if it was 120 days late. They have essentially moved the goalposts back. They've moved the goalposts back. The game is changing even as it's being played. And now overdue loans can go 2 years before the companies have to record the loss.
2 years. Is that just delaying the inevitable, or is that something that, are they hoping for a change?
Well, they are hoping for a change in several regards. They're also sitting on $19 billion in additional losses, which they've not fully acknowledged. And the assumption there is, again, that something's going to change in the real estate market very quickly.
Is something that, like housing prices starting to rise again? Or people starting to pay their bills?
Exactly. This is what you would call high-stakes gambling. Backing their $5 trillion in paper is $83 billion in capital. $83 billion. So they have roughly 1.6% capital.
They have a 1.6% margin for error is what you're talking about.
Right. They're rolling the dice, and we better see sevens. Well,
and just as a repeat from last week, we had talked about how last year what we were talking about with Fannie Mae and Ginnie Mae was a little less than half of the mortgages out there. What was it, 46%? Mm-hmm. And then within 1 year, they've doubled that. They're in the 80s, aren't they? In the 80% range 82%. Of all the mortgages out there?
82%. So they now are too big to fail. Should they have any capital impairments, you will see the Fed step in. You'll see the taxpayers step in and bail them out. So a couple of noteworthy things there in the news. We've been dealing with is a little bit more conceptual in the last couple of weeks, Kevin, and we've introduced some ideas relating to Keynesian economics, to Austrian economics, and we thought that it would be fantastic to bring Mark Skousen, an old family friend, and someone that I've known going back to when I was a teenager, have him online. He is an expert economist, has taught at the Columbia Business School, and has written numerous books on the history of economics and also more current event type things as well. I want to strongly suggest that our listeners take a look at Econopower, his most recent book, published here in 2008 by Wiley, and it's subtitled, How a New Generation of Economists is Transforming the World. So, Mark, we wanted to invite you into the conversation. We don't know if your opinions will be the same as ours or different, and we're looking forward to it either way.
Well, my view is that this is a classic example, this real estate debacle and the credit crunch that has followed as a result of what was thought to be a small part of the real estate market, the subprime market, is a classic example of Austrian economics at work. And what I mean by that is the Austrians are the only school of economics that talks about structural imbalances and the inherent instability of an inflationary policy by our monetary authorities. And so normally, if you follow the Keynesian model or even the monetarist model of Milton Friedman, their view is that inflation is relatively benign. Yes, it raises prices, it stimulates the economy, and so that's a good thing, but the bad side is it raises prices, but it's not a destabilizing factor in the economy. And this is just totally wrong, and this is the Austrian view that inflation is unstable because inflation doesn't spread equally in the economy, that some sectors benefit more than other sectors, and so you create these asset bubbles, whether it's in real estate or in the stock market. And in the stock market, unless everything is highly leveraged, stocks go up, stocks go down, it's not as much of a problem. But when you're in real estate and you create an artificial bubble in real estate, and this most recent bubble of the year 2000, or the last cycle that lasted until 2006 approximately, maybe a 10-year period, was unprecedented in terms of the United States markets going through the roof. And, when you borrow money and you have leveraged positions in that, then the unwinding, when prices go down, as they've been doing for the last year and a half or 2 years, suddenly those mortgages and the amount of money that was made on paper totally evaporates, and it puts this incredible constraint on the economy and our financial system. So this is a new capitalism, if you will, to have to deal with these strains in the marketplace. And the Fed knows this. The Fed, I think, recognizes, in a sense, it's the enemy out there, the enemy of the markets, because government is intervening in a very big way, not only Congress, but particularly the Federal Reserve in their aggressive stance and collateralizing and working with Freddie Mac and Fannie Mae to nationalize, if you will, the mortgage business and collateralize that. And did you notice they even added student loans? That's how far this thing is stretched, is now even student loans can be securitized and collateralized when commercial banks and investment banks go to borrow money from the Fed. So it demonstrates clearly that this is straining the markets as never before. The Fed's program does seem to be working. I think your emphasis on the negative news, you should point out on the positive side, the fact that the stock market has been in a recovery mode here for several months now is an indication that, and also I should add, the crisis premium on gold that was quite high, pushing gold over $1,000, has come down quite a bit, and that's an indication that I would say even most analysts now think that the fear of a Great Depression and absolute collapse has abated sharply, and that we might get out of this. But what are we going to get? What's the new world out there? And the new world out there, I think, is more government regulation, more intervention, the Fed becoming almost an integral part of the financial system with its bailouts of Bear Stearns and the mortgage markets and the student loan market and so forth. After a while, the Fed becomes a permanent emergency power to step in and intervene constantly. And the end result is just a more inflationary environment. So I would not be selling gold, would not be selling oil, commodities in general. I think these prices